You're listening to AI PRISM from Seoul Economic Daily.
It's Thursday, May 14. I'd like to share some thoughts about retail investors. Imagine owning the fastest horse in the race, only to realize the racetrack itself is, well, about to be shut down.
Right. That's kind of the reality for anyone holding Korean tech exposure right now.
Exactly. So our mission today is guiding you through three major shifts in Korean exposure. We're looking at a historic chip valuation reset, surging commodity returns, and utility margin squeezes.
Plus a pretty massive looming strike risk.
Yeah, we have to talk about that. But let's start with that chip giant reset. For years, if you tracked Korean equities, Samsung Electronics was it was the undisputed heavyweight.
Oh, absolutely. But that dynamic just completely fractured. SK Hynix recently hit a record share price of $1,976,001.
Which is roughly $1,400 US.
Right. And because of that surge, Hynix's 2026 forward PER, their price-to-earnings ratio actually pushed up to 6.79x.
Oh, wow.
Yeah, which edges out Samsung at 6.77x. The premium Samsung historically held is just, well, it's gone.
That's wild. The market cap gap between the two is now around 252 trillion won, so roughly $178 billion US. How did they pull that off so fast?
It really comes down to HBM, or high bandwidth memory.
Those are the high margin product lines, right?
Exactly. They're critical for AI, and Hynix just caught that demand wave perfectly.
So for retail investors using like the EWY ETF, it's almost like, well, you're no longer just picking the fastest horse, you're betting on the memory demand track itself.
Yeah, that two blue chip trade is completely resetting. Since Samsung's premium evaporated, those EWY-style products just won't get a disproportionate boost from SK Hynix outperforming anymore.
The seesaw is perfectly balanced now.
Right, and that actually brings us to the biggest near-term risk for that ETF. Because it relies so heavily on those chip giants, the threat isn't just valuation.
It's the fact that production could literally halt.
Exactly. We're looking at a massive assembly line blackout.
Right. The same EPA. That's the Korean acronym for the Samsung Electronics Union. They've got a general strike scheduled for May 21st, pending a court injunction.
And the stakes for this are staggering. Industry estimates show a worst-case shutdown loss could hit 43 trillion won.
About $30 billion US.
Yeah. And get this. Even just a 10% drop in semiconductor exports shaves 0.78 percentage points right off the entire Korean GDP.
Wow, that's a massive hit.
It is. Furthermore, JP Morgan warns that the wage deals they're negotiating could end up cutting operating profits by like 7 to 12%.
So with tech facing these strike risks and the valuation reset, capital is obviously scrambling for a place to hide. And investors are finding returns in hard assets right now to absorb the shock.
Definitely. Look at LME copper breaking records at $14,021 US per ton.
Yeah, and silver futures hit $87 US per ounce. That pushed Korean leveraged ETNs up between 20 and 33% in just a single week.
The underlying story there is pure supply and demand. China's clean energy exports, which are super copper intensive, rose 14%.
Okay.
And at the exact same time, Indonesia delayed output at its Grasberg mine.
Right, but I have to push back a bit here. Should you really view this as a structural shift? Or is it just a fragile hedge that's super vulnerable to a stronger dollar?
Oh, it's absolutely fragile. If the dollar strengthens or if China's demand cools even slightly, those ETF gains could evaporate fast. It's a short-term buffer.
Yeah, that makes sense. And speaking of surging commodity prices, those costs are actually threatening yield-seeking investors holding utility stocks.
Right, specifically KEPCO. They just quietly posted a first-quarter operating profit of 3.78 trillion won.
Roughly $2.7 billion US, which, it's pretty solid.
On paper, sure, but there's a hidden trap. It centers around the JKM, the Japan-Korea marker, which is the benchmark for spot LNG prices.
Okay.
That marker jumped 70% compared to pre-war levels.
And since LNG sets the system marginal price 83% of the time, that's a huge problem for them.
Exactly. It dictates the cost of their most expensive power. And because KEPCO is politically constrained from passing those costs to consumers,
they just have to eat the losses.
Right. So analysts are saying Q4 could easily plunge them back into the red.
Wow. Well, that leaves us with a final, somewhat provocative thought to chew on. If your Korean tech, your utilities, and your commodities are all ultimately governed by global supply chains and foreign demand, how much of your local exposure is really just a proxy for global macroeconomic weather?
That is the big question you have to ask yourself.
That's today's AI PRISM, Retail Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a WAN-IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.